Hi guys, it's Ian from Signal Centre. Welcome to today's webinar. Today I want to talk about indicators. Now, very basic indicators. All of these indicators that I'm going to discuss today could be used or discussed in a webinar. Just turn down the volume on their own. Okay, they're quite in depth. We could go into all the calculations, all the different parts of the indicators, but today I just want to talk about basic indicators and just give people an outline of the different type of indicators that we have out there in the marketplace. Believe it or not, some indicators you can't talk about without getting a license or paying a fee. That man, as we put it, only allows people to talk about his indicator if you've got prior permission. So I won't be adding that one in today. And just give you an idea, it's not DMARC, and it begins with B. So what we are going to talk about, let's just go to the first slide. We're going to talk about what is an indicator. Okay, on the chart or off the chart, we're going to give some examples of different types of indicators. So the first one I'm going to talk about is the ATR. The next one is the RSI. The next one is the moving average. Actually, two different situations or way to use the moving average. And then lastly, I'm going to talk about the Ishimoku cloud. The reason I've picked those four different types of indicators is because they all offer something different. The ATR offers a range. The RSI highlights overbought and oversold. It also highlights something called divergence, but again, bullish and bearish divergence are really a standalone subject, and we'll be doing that in a different webinar. Moving average. So moving average, the trigger that we can use from moving average crossovers, but also how to define a trend from moving averages. And then the last one is the Ishimoku cloud, which highlights support and resistance. So a technical indicator is basically a mathematical tool that helps us try, and obviously that's a very big word in trading, try and decipher different situations that we're possibly in overbought, oversold territory, possibly a change of trend. Again, as we say quite a lot, I think, when we're talking about technical analysis, never use one indicator on its own. If we're looking for a change of trend, then use a basic indicator that might highlight a change of trend, but then you can also use price action, or you can use maybe a chart formation, maybe an ending wedge pattern, etc. So these indicators, again, they're good as overlays on charts, but price is most important. Support and resistance, and then the average range. So leading or lagging, and that's quite an important factor when we talk about technical indicators. Most of the indicators that I use personally are all leading indicators. I want to know where I believe price is going to go, or where price is possibly going to stop and reverse. So a lot of the indicators that I use are forward indicators, leading indicators, such as the Ishimoku cloud. That's a leading indicator. It tells us where price is possibly going to go to. Trendline support resistance is a leading tool. It's not a leading indicator, but it's a leading tool. It shows us where support and resistance is in the future. Elliott wave is a leading tool because it shows us possibly where the fifth wave is going to go, or the third or the fourth wave is going to go. And as such, obviously, fib levels are leading indicators. So we've either got leading or lagging. Leading highlights support and resistance, or areas of interest based on future price action. Lagging highlights what price action has already done. So lagging indicators, well, we're going to discuss a few here, so let's get on to them. So on the chart or off the chart, obviously some indicators are overlaid on the chart. So I'm just highlighting an Ishimoku cloud here. It's highlighted on the chart. Okay, then we've got off the chart. So these oscillators, most oscillators are highlighted at the base of the chart, and this is the relative strength index. Now it's down at the bottom of the chart, so it's a standalone indicator. Okay, it doesn't sit on top of price action. And indicators that sit on top of price action, let's just go back here, they're basically highlighting places on the chart. So if we look at this one here, then we've got an exact level of where there's possibly resistance in the Ishimoku cloud, and that's a 4-hour euro dollar chart. So it's broken into the cloud, normally mixed and volatile. We know that the next resistance level, as far as Ishimoku cloud is concerned, is up there. We could possibly have a fib level there, which would add into it, etc., etc., etc. If we go to, this doesn't give us price. This is an off the chart indicator. So we're not highlighting price. We've got to decipher price ourselves. What it's highlighting is overbought, oversold and overbought territories. Okay, so here overbought, down here for quite some time actually, oversold. One thing we should also remember about the RSI when we get onto the RSI is that oversold does not mean buy and overbought does not mean sell. DMARC, and I always talk about DMARC quite a lot, but DMARC actually has an indicator that is based around, or that's the same sort of fundamental strategy as the relative strength index, and it actually says overbought buy as opposed to overbought sell, but that's another subject. So the first one we're going to talk about is the ATR. Okay, and this can be used in various different ways. This is an indicator called the average true range, and the average true range is worked out of a period. So you can use it on 4-hour charts, hourly charts, etc. But most technical analysts, most traders will look to the daily chart. And again, you can add in your own time period. The preset for the ATR is 14. So basically, what we're looking at is 14 days worth of price. It's a leading indicator. In other words, it's showing us support, possible support or resistance into the future. When I say into the future, for that day's range, for that day's trading session. It's not going a week or you could do if you use the weekly ATR, but most traders, like I say, are only using the daily. So it's showing you resistance or support for that day's session, and it's an off the chart indicator, but this is where it's a little bit mixed. It's an off the chart indicator, but we can plot the level on the chart. So let's just go here. The ATR, the average true range, the peak was 155. Now that means you can see a strong rally up there in the range of euro dollar daily chart. You can see that visibly as well. Obviously this was the range before, so the daily range was quite small. It then started to build and obviously got extremely large with 155 pips. So that basically means that the average range of euro dollar for the last 14 days was 155. It's an easy calculation. You literally add the range of every single 14 day for the last 14 days, add them all together, divide them by 14, and you've got 155. We don't want to do that ourselves. We've got an indicator to do it for us. It's currently at 150. So interesting here, different ways that you can use this indicator. Now, if the average range is 150 and we've seen a strong rally up in days price action as we did today, then we know that the average for the last 14 days is 150. So if we look here, oh, sorry, I shouldn't have clicked on the chart. Should go up here. If we look here, then the base of this chart is at 108.70 plus 150, 110.20. Now, that might be either a good area to start shorting euro dollar because you believe that the range, it's overextended itself and it's probably not going to go much higher. Or if you're already in it, you could have it a stop placed above the average true range. So in other words, I'm already committed to a trade because I've had some other indicators that have told me to get short of euro dollar, and that's where I'm going to place my stop. Just going to see where euro dollar is at the moment, actually 109.92. So it hasn't got up to the average true range as yet today. So again, it's a forward indicator. It's off the chart, but it's also on the chart because you can plot that resistance level or that support level on the chart. There is an indicator out there, especially on TradingView, that gives you what's called an ATR range, and it actually pre-plots the range actually on the chart. So instead of having to do the calculation yourself, it'll actually have a line on there which will show you the average true range for the last 14, 15, 16 days, whatever. The RSI, probably the most used indicator, along with MACD maybe. The RSI stands for Relative Strength Index. It's a momentum indicator that measures the speed and change of movement over a specified time period. Okay, great in all time frames. It's a lagging indicator, and by that, what I mean is that basically it's plotted after the price action has happened. So it's not telling me what's going to happen, it's telling me what has happened. Okay, it's an off the chart indicator again, so it's down the base of the chart. It can be good for overbought, oversold territory. So here, obviously, we've gone oversold, but again, we've stayed oversold for quite some time. The official or the proper way that you're supposed to use an RSI indicator is that you wait for it to break back into the zone. So the zone on the RSI is 70-30. If you go below 30, you're deemed to be oversold. If you go above 70, you're deemed to be overbought. If you break back above 30, then you're coming back into range, okay? And that is normally an indication to get long of a currency pair index, commodity, etc. Don't use it on its own. You might want to use it as with a moving average crossover. You might want to use it with some price action. You might want to use it with DMARC. You might just want to use it with something else. But like I said, these indicators, oscillators, in my view, shouldn't be standalone products. And then here, obviously oversold, and then we came back into the normal territory. MA, moving average. There's simple moving average, exponential moving average, weighted moving average. Again, that's probably a complete webinar subject, a long webinar subject just on its own. But today, we're just going to talk about the simple moving average. It's used in its rawest form to identify the direction of the current trend. It's a leading indicator. In other words, it's telling us where the trend is, and a lot of traders will use a moving average as support or resistance, and that's the main reason why I'm saying that it's a leading indicator. Obviously, it's slightly lagging because it's told us what has happened and we're in the trend. And when we look at moving average crossovers, that's a lagging indicator. But just for this slide, if you like, it's regarded as a leading indicator because it can act as support or resistance as we move higher or lower. It's plotted on the chart. So let's have a look at a slide which is just some very simple moving averages. The popular ones, I suppose, 200-day moving average is used a lot for long-term traders. As you can see here, this is a 240-minute chart. It's virtually flatlined, and yet we've had massive swings in both directions. So not the best indicator for day traders, etc., etc., etc. What we have here is the 50 indicator, MA. So it's basically taking the average price of the last 50 bars, and it's the average price, excuse me, of the close of the last 50 bars. And then we go to the 20 here, and we can obviously see this one is the furthest away from price action. The 50 is the second furthest away, and then the 20 is the closest. So the shorter your moving average, the more reactive and the closer to price it will be. And as I said previously, some will just use one moving average as support and resistance. So this is quite a good example. We've got the 20 moving average acting as support. It then gets broken here. It then acts as resistance, gets broken there really, and then acts again as resistance, acts as resistance, nearly acts as support, etc. So can be a forward indicator, and traders use it in different various ways. And it also, one thing that you should remember as well, when you're looking at MACD, which is moving average convergence divergence, it's obviously a major factor within that calculation. MACD again is a standalone indicator that we'll talk about in another webinar. It's a fantastic indicator to highlight bullish and bearish divergence, so we'll probably combine it into that webinar when we do it. Might do that tomorrow. Moving average crossover, it's a very simple tool. Moving average crossover, a very basic trigger system. It's a lagging indicator, as I said, and it's plotted on the chart. So here we're just using the same chart as we had before. This would have been a indication to buy euro dollar, and this would have been, oh, I lost it again, sorry, and this would have been an indication to sell. So to buy, to sell, you can see how much that lags the market. I mean, you're probably going to be getting in on this candle here, and this was the top of the trend. You did hold on for quite some time. You might have wobbled a bit on that move to the upside. Then the next one that I want to discuss is the Ishimoku cloud. The Ishimoku cloud, also known as Ishimoku Kinko Hoi, it defines support and resistance, and the reason that I like it as well is that it is a usually leading indicator, in that it doesn't just highlight support and resistance, it highlights support and resistance into the future. It also highlights the depth of that support and resistance. We'll talk about the depth when we get onto the actual chart. It also identifies trends, so it can be a standalone trading tool, and it has elements in there that are quite similar to a moving average crossover, but not. The Zen lines, as they're called, are slightly different to a moving average, but again, Ishimoku cloud could be a half-hour webinar just sat on its own, if you like. But we're talking about basic indicators here and the basic formation of indicators, and the different aspects that they offer us. So here we've got the Ishimoku cloud, same slide as before. What we like is, or what I like is the depth of the cloud. Okay, so if you've got quite a deep cloud to the upside, then this level here, this is the resistance, and this is resistance here. So the deeper the cloud, the more resistance. But also we've got these lines here. So these are these Zen lines that I was talking about. And if we break the cloud to the downside and the Zen lines are in order, then that is deemed to be quite good indication of a trend, change of trend, especially when you've got thick cloud cover above. You've also got something called a lagging line that you need to keep an eye on. A lagging line is this line here. So there's a lot of different aspects to the Ishimoku cloud. The lagging line, even though you break through the cloud to the downside, the lagging line needs to be below the cloud. I think it's 26 periods previously. Otherwise, you could see a correction higher, as what normally happens is price will bounce off the cloud, or this lagging line will bounce off the cloud and then move to the upside. You might note there and say, well, it didn't quite get to the cloud, but if you look here, it's because it's the closing price, okay? So if you look back along here, it did actually touch the cloud, but that line there is the closing price of this candle. And that's why it hasn't quite touched. So what happens is it comes down, that lagging line touches, moves back up to the resistance, but the moving averages are still in order, moves to the downside. All sounds very easy, and we should all be using it to trade. But like I say, most of the time, well, not most of the time, a lot of the time, these indicators don't work as a standalone thing. Sometimes the higher time frame, which we talked about yesterday, will be dominating the trend and telling you that you actually should be buying that dip, not selling it. So there's a lot more to just placing an indicator on a chart and using that to solely decide your trade ideas. But I'm very big on trying to build different trading systems. And of course, you can't do that if you haven't got indicators. Okay, guys, I hope you enjoyed that. We'll be back again soon with some more webinars. Many thanks.